Hi, welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Jeremy Miller. Jeremy is a research analyst at a large New York-based asset manager. Today we're going to be discussing Warren Buffett's ground rules, words of wisdom from the partnership letters of the world's greatest investor. Jeremy's an expert on Buffett's early partnership years. Let's ask him 5 good questions. All right, welcome back to the show, everybody. My guest today is Jeremy Miller, author of Warren Buffett's Ground Rules. Hey, Jeremy, thank you so much for taking the time to be with us today.
Yeah, it's great to be here. Thanks for having me.
Well, I'm a self-admitted Buffett fanboy, so I'm really looking forward to this interview. And I think a lot of his pre-Berkshire stuff is underappreciated. So let's jump right in. Question number 1. You, having thoroughly gone through Warren Buffett's partnership letters and spent a lot of time in that pre-Berkshire era, and also I imagine followed Buffett after during the Berkshire era. If you had to guess, and I know this is like a really tough question, but if you had to guess at what % of Buffett's current wisdom, intellect, effectiveness today would be 100%, how much do you think that he had, let's say in 1970 when he closed his partnership?
Right. Great question. I think, whatever the number is, it gets smaller by the day, right? Because he really is a learning machine. And, Munger talks about this a lot and how, each decade was a successive improvement on the past decade. And I think that's certainly true. But what is interesting to me is this idea of principles on the one hand and tactics on the other. And I think when it comes to the principles, whether it's what was formed from, his time with Ben Graham to, ultimately what drove his own set of operating principles, I think those were fully formed, probably well before 1970. I would say maybe slightly after the Dempster experience, which was in the early 60s, where he really learned the ideas about, managers of money are better, when they think like business people, and business people are better when they think like money managers. After that experience was had, I think his principles as an investor were solidified. Now, tactics certainly changed. He went on to become more of a quality contrarian and a compounder-focused investor, in part because his funds were growing and that's what he needed to do, but also because he found it to be better. And so that to me is the part that continues to evolve in Buffett's investing style is, a refinement of the tactics that are required to meet the situation at hand for him, with basically $40 billion of cash getting generated annually.
Yeah. So he had all of his principles really set, and now it's just an application that varies, but really you could almost predict what he's going to do based on those principles.
Yeah, I think so, and it's really about the idea that the principle is unwavering, right? It's the principles can't cycle around a market environment, right?
Right.
The market environment cycles around the principles. And that's a key concept and really the reason why, he closed the fund when he did, because he wasn't going to change his principles, and he couldn't find anything to buy. In 1999, when he was at Allen Company and people were writing articles about why he was washed up and, the world had passed him by and all that stuff, same thing, almost exactly the same thing. His principles dictated inaction. And so inaction is what he did. He wasn't about to, change those.
Right. Chase internet stocks and.
Right. Or just be involved in things that he didn't understand.
Right. So question number 2, who was Harry Bottle and how was he so important and as a kind of a precursor to the decentralized Berkshire model?
Sure. Well, Harry was a friend of Charlie Munger's, and Buffett in 1961, I believe, flew to the West Coast met Bottle for a couple hours and hired him on as CEO that day. And the company in question here is a Dempster Mill, and I don't really believe that the general community appreciates the degree to which Dempster almost took down the partnership. It was days away from having its loan called from the bank, its inventory seized, effectively days away from bankruptcy. It accounted for, well north of 20% of Buffett's partnership. And it was a windmill implements company. So literally think about like pumps and sprayers and hoses and blades and things that go into windmills, that was really good at accumulating inventory and really bad at selling it, right? And so the balance sheet was incredibly lopsided and inventory heavy, and it was not producing the cash that it needed to. So Harry was a turnaround specialist, and he went in and on a weekend painted a line in the stock room, right? And said, basically everybody's fired unless we can get this inventory below this line.
Yeah.
Right. And then he kept repainting the line lower and lower. And, there's $4 million of book inventory in 1961. And there was less than $1 million of book inventory in 1963. So to put that in context, Buffett paid $1.2 million for his stake. So, he got $2 million out of the inventory alone to buy things like assets. But you're right in the thrust of your question, which is that, Buffett wasn't a day-to-day operator. He never was, never really has been, maybe with the exception of, his involvement in insurance. I think he's probably a little bit more actively involved in that business than the others. But for the most part,
maybe Solomon for those
yes,
10 months or something.
Right,
but yeah.
Right. But for the most part, I think, he wants to handle the capital recycling aspect, and he wants somebody else to deal with the actual operations.
So Bottle basically was one of the first operators that Buffett brought in that allowed him to do the capital allocation while someone else was handling the day-to-day, which has been the magic of Berkshire, basically.
Yeah, exactly. So what happened was, Bottle took $2 million out of inventory. Now that's real money. That's cash.
Yeah.
Right. And so stuff was sold, cash was received, that cash got sent to Buffett, and then Buffett bought stocks with the money.
It was funny too that he levered up Dempster some.
Yes.
The operation to buy more stocks, which is kind of a surprising move.
Yeah, and before too long, he had more of the value of the company was in the portfolio of stocks than was in the operating assets of the business. And ultimately, I think incredibly interestingly, he got the operating capital to zero, and then deincorporated the company, distribute the portfolio of equity back to the holders, and avoided a whole layer of tax. Right. But it really shows that sort of fungibility of capital and that mindset that, if you're a manager of a business and, you don't have Buffett as a partner, right, you have to think about your business as if a portfolio manager was thinking about their fund, right? Your capital is what's in the business, just like a fund manager's capital is spread across a bunch of different investments, right? And inventory is the same investment that, a position in American Express is. I mean, both have, an expected return and a set of cash flow that come off those assets. So, this idea, I think, is really important for people both in the money management field and in the, management field, business management field, just to understand that, the idea is to maximize the return on the capital employed. And it doesn't really matter, the form in which that capital is residing. Right. What matters is that it gets maximized.
What's been interesting I've noticed, it seems like the there's been a movement away from conglomerates and more towards pure play in public markets. They get a better valuation when they're a pure play. And I wonder if it's because I guess the viewpoint that the CEOs aren't actually very good capital allocators, and then therefore they're choosing the wrong projects when they're left to their own devices. Whereas on a pure play, they tend to just recycle the money back into that same business that they're doing. And so, it's a little less open to judgment at that point.
Yeah, no, absolutely. And, Buffett's talked about this forever. It continues to talk about it now, right? You're not in a business. You're not in the windmill. He was never in the windmill manufacturing and implements business, right?
Yeah.
He was in business, right? So maybe the CEO prior would have thought nothing but to make acquisitions and adjacencies around things that he thought he knew something about.
Right.
Right. But, that was the scope of it. So, if it wasn't worth doing, it's certainly not worth doing well, right? As Munger loves to say.
Yeah.
And I think that a lot of managers today, try to do things that aren't worth doing well.
Yeah. They're very efficient at it, but it's not effective.
Right, because if it's strategic, right?
Yeah.
It's probably a bad idea.
Right. That synergy never shows up that they were expecting.
Right. And they're not trained that way, right? So if you come up through the sales department, or you come up through engineering or wherever you come up from,
yeah.
You don't have domain expertise that includes capital allocation. And so in some ways it's unfair it's a hard ask of a lot of people who find themselves in the CEO position to understand exactly what it is they're doing and how to value businesses, because it's different than running them.
Right. Yeah, exactly. It's Buffett has said before that it's if you had been a classical violinist, let's say, in training to go and your last step before going to Carnegie Hall was that you had to go run the Federal Reserve.
Right.
Instead.
Yeah, exactly.
So they're just not trained for it.
Exactly. So that's the when you find people that can operate in both realms, it's time to partner up. I think those are the great people to sort of attach yourself to, because they speak your language and you speak theirs, at least part of it, and you can get comfortable that there's a recycling algorithm.
Right. So question number 3, and this kind of goes back to Dempster again, because it's such a fascinating case study. Everybody looks at American Express as sort of this transformative investment for Buffett. A very, he kind of traded in quantitative for more qualitative, buying a good business instead of a cheap business, relatively speaking, and maybe a little more appreciation for brands at that point. So you could make a very strong argument, and you do in this book, that another huge transformation, very formative investment for Buffett was Dempster. I was hoping maybe you could share a little bit more about that.
Yeah, well, there's a number of things to say about Dempster and what was learned by it. What we were just talking about before in terms of the full grasp and understanding it. It was my experience in writing the book to get this appreciation for the idea that, in any business you have stuff, which is your gross PP&E, and you have working capital, which is, your inventories, receivables, and your payables. And those are the things that need to, either be replenished or scale up and down as the business grows or shrinks, right? And here in Dempster, the business had shrunk in sales, but had not shrunk in the capital that was, being utilized to produce those sales. And so it was really over inventoried. And so when he acquired the stock, it started in 1956, really, didn't take control till 61. So he was in it for a long time, sort of marking it to market based on where it was trading. But once he acquired it, his mindset didn't change, but his process started to change, right? Because now he didn't own a piece of paper that, was effectively the conduit through which he owned the assets of the business. Now he actually owned the assets of the business, and he said, let's get to work. And he hired Bottle, and, almost immediately, extracted his cost basis back out of the business through the inventory alone, and then, made some other improvements to it. So, this idea about the fungibility of capital and being a business person and an investor, and sort of having them, the distinction between the two is really false in his mind, I think. They're one and the same.
Yeah.
And then also I would say, being vilified in the press, in Beatrice,
which was where the headquarters of Dempster was.
Of Dempster, exactly. Yeah. And the papers, putting his picture up with like Liquidator, and, really just vilified. And he never really did another one of these. And maybe the returns would have been better if he did. But I think he chose as a lifestyle choice, not that he didn't want to get involved in this kind of behavior anymore. It was much easier to find a compounder and buy it at the right price and let it go.
Right.
Right. There's not a lot of work involved.
And then talk it up instead of having to come in and tear it down.
Right. Exactly. Because, time is your enemy, not your friend, in these tough businesses. And so, he had to make a lot of tough choices, and ultimately he repaired the business to a healthy state, and probably did a service to all those people, because, before he came in, the business was almost sure to go under.
Right.
Right.
It wasn't long for the world.
Right. But of course it wasn't characterized that way, and people didn't quite appreciate that. So I would say that, maybe the other thing to add, just to fill in a little bit, is that, he limped into American Express and really via his investment in Disney, right? And, not only did he buy a good company with a strong brand in both cases, but in both cases he also bought them incredibly cheap.
Yeah.
So it might not be as cheap on a gram metric of, book equity or something of that nature, but still, severely depressed prices relative to their histories, right. Where, there was sort of a discrete call that he could make on, the survivability of the business. A lot different than say paying what he did for precision cast parts today, which yeah. I'm sure he's just as comfortable doing that as he was back in the day with American Express, given the way he's evolved in his thinking and so forth. But, it certainly was cheap then too, which I think is a distinction.
Yeah, there's a big difference between buying it 35 times earnings or so versus 5 times earnings as far as getting your money back.
Right.
So question number 4, and this is a great segue. Buffett has said now, and it's been a few years since he said it, and I think he probably still believes it, but that he could put up a 50% return if he had to run a small amount of money. I think he said like $1 million portfolio.
Yeah.
Do you think that that's possible in today's world, just the market that we see today?
I can see why one would be skeptical, but my general sense is that he could, and I'll answer it this way, just for perspective. The Dempster position, which was 20 or 25% of his portfolio, was $1 million investment, right? So, the idea of being able to put the Geiger counter over what would be, the equivalent of 5, 6, 7, $10 million market cap companies, right, is a whole different field, and a whole different area where, there's not a ton of transparency. There's no coverage on Wall Street. The information isn't always readily available. And so, we saw that very similar thing in Sanborn Map was with a map company where he sort of put himself onto the board and took a significant, it's super concentrated, right?
Yeah.
And took a significant amount of the partnership into Sanborn, right? And made a really good, quick turnaround. It probably wasn't more than a year once he got going there. So those sort of special situations, one I wrote about in the book is this company Namtai, which was, it's a Chinese-based, U.S.-listed former contract manufacturing company that's transforming itself into, a property developer and real estate company that is a net.
Yeah.
At least it was when we published the book, and they've done some things like some share buybacks and so forth. But the point's the same. Like, it's a $200 to $300 million market cap with no analyst coverage in China.
Yeah.
Doing real estate. All the things that, you would sort of check off as to what's out of vogue today. Right. And it's just super cheap. It was cheaper than the cash on the books net of all the liabilities. So, you can see these sort of special situations, even in today's, tougher market, 6 years, into the recovery. It's hard to find, broad swaths of cheapness. But, when you take your funds down and you've got his skill set, right, and ability to put the Geiger counter over this stuff, then, I wouldn't be terribly, terribly surprised because, you only need a couple and you can't make mistakes. And I think that was really a key for Buffett, was just as much as it was finding the right opportunities, it was avoiding the mistakes and sometimes just avoiding them, like in Dempster, but, it worked out okay.
Yeah. I think every great investor has had their where they had to roll up their sleeves and get in and save an investment, basically, where it might have been a mistake. They have to come in and make some corporate changes, actions to kind of bail out what I don't think you're a real, blue chip investor until you've had to go salvage a business at some point.
Yeah, that might be true. I hope I never get the title.
If that's the way you got to earn it.
Yeah, exactly.
So question number 5, and I find this to be a very profound topic in today, is the idea of conservative versus conventional. You draw some really great inferences between those two, and I was hoping maybe you could talk a little bit more about that, because I love that concept.
Me too. I adore it, and I try and really incorporate it into the way that I think about markets and stocks. And there's a somewhat of a disservice, I would say. Maybe it's too strong a word, but all this efficient market theory stuff that has been to some degree discredited since we started talking about behavioral economics and things like that. But the idea that because other people agree with you, you're right, just doesn't hold for Buffett and never has, and, so an outcropping of that other school of thought would be, this idea of beta and, the idea that risk is a sort of a quantifiable number associated with, the degree to which a stock like sort of squiggles around from day to day,
right,
over some trailing period. Right. And so stocks that go down become more risky. How does that make any sense? It's the same business. It's just at a different price. Right. So to Buffett, risk is not knowing what you're doing. Right. So, do you understand this business? Do you understand what drives the business? Do you understand the range of potential outcomes that could truly affect this business, right? And then, can you value it, right? And, are you being asked to something? Are you asking something of the business that you're not necessarily sure it can produce, in order to pay today's prices, right?
Mm-hmm.
And asking all these kinds of questions allow the investor to value the business, right? And then you look to the market, right?
Yeah.
Then you go to the market and you say, is the fact that there's a public market for the securities underlying this business an advantage or not? And that just means, is it cheap relative to
what I think
the
it's
assessment?
worth.
Right. But you have to know what it's worth, right? So that to me is sort of the big tragedy for the everyday investor who doesn't have this concept of true north when they come into investing, because what happens more often than not is that the market has its inevitable hiccup, downturn. I mean, we know for certain that there's going to be a recession sometime over the next decade. We just don't know what year it is, right? But
Sure.
we know there's going to be another 30, 40% drop in stocks in some year over the next decade, right? So when it comes, what are we going to do about it? I think a lot of times when individual investors or any investor who doesn't have this concept really ingrained, when this happens, the market is informing them,
Mm-hmm.
right? And so they sell just at the wrong time, right? And it just crushes the return. So the long-term, average return for most people is like 2% when the market gives you 10, and it all has to do with the timing of when they come in and when they come out. And when it's conventional to buy stocks, it's usually not conservative, and vice versa. So to Buffett, it's having your facts right and having them reasoned through properly, over the course of many transactions, will demonstrate your ability to keep up with or even outperform, the broad averages over time. And it has nothing to do with whether the talking heads on CNBC are barking in your favor or against.
Yeah. I think that's I think that's why the individual investor often has such a hard time knowing when to sell, is because they don't have that true north value of, this is just about pretty fully priced at this point, or maybe even overpriced. I should probably sell. They're just, it's going up. I'm just going to keep holding it until it stops going up. It just makes it that much more difficult.
Yeah, exactly. And this idea, I think, needs just to somehow get into the general domain in terms of the way that we talk about investing. It's often portrayed as a game, sort of a win lose or a lose win, and there's a loser for every winner, and to a certain degree that is true when you're an active investor, but in another way, over the long term, the investor's experience cannot be materially different than the business's experience. Right. And that's certainly true ultimately, and in the end, they will be identical. There's mathematically no way for the performance of an equity in aggregate to do different than the business, because the equity is the conduit through which the business is owned. Right. And so I really wish that people would embrace this concept more, that when they're owning stocks, they're not looking for the greater fool to sell their holding to, right? They're looking for the underlying value of the assets, and the cash that those assets produce, increases over time, and that's how they make money. And, they'll do better than average when they find assets that are positioned in a better than average way to produce better than average cash flows on the assets that are employed, right? And so it's not about finding some dumb person to sell your stock to, or a dumb person to sell you their stock, right? It's taking on your role as the provider of capital to the business, right, from its former provider,
right?
Which dates all the way back to the beginning of the business,
IPO, yeah.
Right, and or even the guy that founded it with $50 and $1,000 from his father-in-law or whatever.
Right.
right? I mean, that's the founding capital, right? And then, so, this whole idea of taking on your position as the capital provider and capital owner of the business, and then, getting, your fair return based on what the company does. And you can do that if you think out past 3-4 years, after that time frame, unless the multiple you pay is vastly higher or lower than intrinsic value would dictate, right? You're really going to get a return commensurate with the business. It's only when you compress your time frame to a year or 2 or 3 years, or certainly if you compress it to months, days, weeks.
What's the average
right?
holding period now? It's like it's under a year.
Yeah, right. So I think it's well under a year, right? And when you're playing that game, it's the beauty contest analogy where you're judging the judges and not the contestants, right?
Exactly.
You're looking to what the market is going to do as opposed to what the businesses are going to do. And certainly if you and I owned a dry cleaning business and somebody came in and offered us $5 for the place, you'd kind of just laugh, right? But it wouldn't freak you out, right? I mean, you wouldn't panic because somebody just came in and randomly offered you a super low price for the business, right? So why should that be true for the assets that you own through fractionally through the shares that you hold?
Yeah, I couldn't agree more. So, bonus question we always ask everybody, and this is for a book recommendation. What do you have for us today?
Well, it's a bit heavy, but I would definitely recommend Poor Charlie's Almanac. I think that this is a collection of essays and speeches by Charlie Munger, collected by, is it Peter Bevlin?
Kaufman, I think.
Kaufman, sorry.
Yeah.
Good. Thanks for that. But it's got all Charlie's wonderful sort of multidisciplinary approaches to thinking about the world in general and investing specifically, and I just love the interaction between the two of them. And I think any real student of Berkshire needs to have a full understanding of both. The Berkshire wisdom is incomplete without a good, careful study of Charlie's stuff, and there's no better place to find it, than the Almanac, even if it is like 1.5 feet by 1.5 feet or whatever.
No, I agree. It's totally worth reading, and not even just to understand Berkshire, but just to understand life better. I mean, this is as close to the horse's mouth as you can get, basically, of probably one of the smartest people to ever live. I don't know how you not read that book.
Yeah. And, just to throw an extra one in, because, I try and listen to it at least once every 6 months, is, the speech that he gave. No, I was thinking about the 24 Standard Causes of Human Misjudgment.
Okay, yeah.
Which, is chronicled in that book, but you can also listen to it on YouTube. So, it's one thing to read a speech. It's another thing to hear it from, the man himself talking about, the poor rubes and, his worthless friend that he likes to play bridge with that, taught him about the boiling frog, and, just to his euphemisms and the way he expresses himself, I think is just wonderful. And it just brings to life that speech in and of itself. Yeah.
That's great. I'll try to link to that one in the show notes, the YouTube.
Yeah. Awesome.
Well, Jeremy, we really appreciate you coming on, and it's been amazing to hear all your insights, and you wrote a hell of a book about a time period that I think is underrepresented.
Well, thanks so much, and we love your show and love what you're doing, so happy to be a part of it. Thanks for having me.
Thank you. Thanks for watching. I hope you enjoyed this interview. If you'd like to support this author and purchase their book, click here. If you'd like to become a subscriber to 5GQ, click here. And I included a couple other interviews that you might appreciate right here. Thanks. Happy reading.